Hey there and welcome back to my channel. My name is Pablo and today we're diving deep into the world of automated trading systems with our ultimate guide on backtesting. If you've ever wondered how to ensure your trading strategy is rock solid before risking real money, you're in the right place. We are about to walk you through 20 crucial steps that will take your backtesting game to the next level. Before I forget, if you like this type of content, don't forget to like and subscribe. Okay, let's get started. First up, let's talk about choosing a reliable backtesting platform. This is the foundation of your entire process, so it's crucial to get it right. Look for well-supported platforms like MetaTrader, Backtrader, or QuantConnect. Make sure the platform you choose supports the asset class you are trading and offers Python support for flexibility. You'll also want features like optimization and data visualization. And here's a pro tip: steer clear of unverified software that might introduce silent calculation errors. Next, we need to gather high-quality historical price data. This is where many traders stumble, but we've got you covered. Only use verified, exchange-based data, feeds that match your strategy's time frame. Don't forget to include bid-ask spreads, not just closing prices, and watch out for survivorship bias in your data. It can seriously skew your results. Once you've got your data, it's time to clean and pre-process it. Remove any duplicate price points and obvious outliers. You'll need to interpolate or forward fill missing values and normalize your data to ensure consistency across time frames. Don't skip this step, it's crucial for accurate results. Now, let's get into the nitty-gritty of coding your strategy logic. Write modular code with reusable functions and simulate orders realistically. Make sure you handle edge cases like low liquidity and overnight gaps. Include verbose logs for transparency and validate every module with unit tests before you start backtesting. Defining clear entry and exit rules is where your strategy really comes to life. Use technical indicators like RSI, Bollinger Bands, or moving averages. Combine price action with volatility filters and factor in sentiment or news-based triggers. And remember, every rule should have a statistical justification backing it up. Risk management is the unsung hero of successful trading strategies. Implement hard stop losses for every trade and cap your portfolio risk per position. Use trailing stops to protect your profits and diversify across uncorrelated assets. Don't forget to simulate different position sizing models to find what works best for your strategy. Now it's time for the moment of truth, running your first backtest. Run a full backtest on historical data using your defined logic. Compare performance across bull, bear, and flat periods. Log every trade and event for detailed analysis, and pay close attention to where your strategy fails, not just where it succeeds. Once you've got your initial results, it's tempting to jump straight into optimization, but hold your horses. Optimize parameters cautiously, using grid search or brute force only within logical boundaries. Keep parameter ranges realistic based on market behavior and prioritize robustness over perfect fit. Always cross-validate after optimization to ensure you're not overfitting. Avoiding look-ahead bias is crucial for realistic backtesting. Make sure no future price data is used in your indicators and avoid using post-trade results to adjust logic retroactively. Code everything as if it is running in real time and include lag and signals. To mimic actual market delay, survivorship bias can seriously skew your results, so it's important to eliminate it. Include delisted and bankrupt stocks in your datasets and use historical index compositions instead of current ones. Test across entire asset universes, not just top performers, and compare against real-world ETF or fund results. Data snooping is another pitfall to watch out for. Separate your exploration data from validation data, and use walk-forward or K-fold cross-validation methods. Limit the number of strategies you test on one dataset and do chase curve fits. Pursue repeatable patterns instead. Speaking of walk-forward testing, this is a powerful technique to ensure your strategy's robustness. Split your data into multiple walk-forward slices, train on earlier segments, and test on future periods. Re-optimize. parameters at each walk forward step and evaluate consistency, not just total return. When evaluating your strategy's performance, don't just look at total returns. Analyze real risk metrics like max drawdown, volatility, and Sharpe ratio. Add the Sortino ratio to account for downside risk and use profit factor to measure return relative to loss. Visualize equity curves. No curve should rise too perfectly. Don't forget to simulate slippage and commissions in your backtests. Include round-trip commissions per broker pricing and model varying liquidity across hours and markets. Stress test against high slippage scenarios to ensure your strategy can handle real-world conditions. Testing across different market conditions is crucial for a robust strategy. Test in bull, bear, and flat markets across multiple years. Simulate black swan events like 2008 and 2020 and include macroeconomic news spikes and volume shifts. Look for strategy decay or breakdown zones to identify potential weaknesses. Always benchmark your strategy against buy and hold. Measure drawdowns versus passive investing and track volatility-adjusted returns against ETFs. This will help you determine if your system's extra effort is worth the edge. Don't limit yourself to a single asset class. Test your strategy on stocks, forex, crypto, and futures. Note behavioral differences in each market and adjust volatility filters accordingly. Track metrics separately to avoid confusion and identify where your strategy truly thrives. Evaluating your strategy with and without leverage can provide valuable insights. Measure the impact on drawdowns and margin calls. Adjust stop losses based on leverage risk and simulate interest or funding costs. Monitor how the risk-reward profile changes in different leverage models. Finally, don't forget to simulate execution latency. Account for internet, broker, and exchange lag and test how fills change with order delay. This is especially important for scalping systems. Rerun your tests with latency sensitivity analysis to ensure your strategy can handle real-world conditions. And there you have it, folks. 20 crucial steps to backtest your automated trading strategy like a pro. Remember, backtesting is an ongoing process, not a one-time event. Keep refining your approach, stay curious, and always be willing to learn from your results. If you found this guide helpful, don't forget to like, subscribe, and hit that notification bell to stay up to date with our latest trading insights. Until next time, happy trading and may the markets be ever in your favor.